Have you heard the term stock split? Nowadays, it is far more common to see a company splitting up its shares than distributing a stock dividend. This is the case when a company's management decides to replace existing shares with multiple new shares. For example, a company issues a statement in which it declares that its existing 1 million shares, each of which cost $120, will be replaced by 2 million new shares. Basically, the firm splits one of its current shares into 2 new ones. Okay, but the way Company A generates cash flows is not going to change, right? So it is reasonable to expect that its overall market cap will remain the same as before, even though the number of shares is double. Company A's market cap with 1 million shares is equal to 1 million times $120, resulting in $120 million. What would be the firm's market cap when its number of shares doubles? It has to be the same, right? Therefore, the share price of the new shares would have to drop to $60. Okay, excellent. Now to the million-dollar question. Why would a firm go ahead with a stock split? Isn't this a purely mechanical exercise? Well, maybe, but maybe not. It depends. Some companies prefer to have their stock price trading in the range between $20 and $80, as it is perceived as optimal. As was the case with our example, Company A's shares were trading at $120, and the firm's management decided to bring them down to $60. Another reason why a firm could carry out a stock split is the fact that it can be seen as a positive signal for high future earnings. Academic research indicates that companies involved in these activities are usually following them up with a strong earnings announcement. This is why some investors have expectations of high earnings once they hear a firm is carrying out a stock split. It has also been proven that if the earning announcement isn't as strong as expected, the company's price reverts back to its previous level. On the downside, stock splits could have a negative impact on the volume of trading of a stock. A lower stock price, resulting from a stock split, results in more expensive brokerage fees, given that stockbrokers charge more fees for lower-priced stocks. So, as with share repurchases, this isn't a technique that undoubtedly leads your company to an improved situation. Okay, great. We can wrap up this section of the course here. We studied a number of accounts, items, and techniques that have an impact on a company's equity. Thanks for watching.